Well, good morning. So we're in a crazy spot. My office is under construction. So Megan and I decided to come hang out at the house. So you guys have been hearing that we got a new house and it has been a massive whirlwind. So we're here hanging out, getting caught up after her trip to Hawaii and hearing all the great stories.
Mm-hmm.
You were treated well, as you should have been.
Wonderful.
Oh.
It was a really wonderful trip. I mean, there were gifts from the company every night on my bed after turn down service. It was just the nicest trip ever.
So you were treated really special, and you should have been. So talking this morning, we're talking about inventory. We're talking about a new report that just came out from Apartment List, which we're going to talk about on the second half. And then, what can we do to help buyers overcome the fear that's in this market today? So that's where I wanted to start my quote. So here's the quote. The number one predictor of success is grit, right? The ability to persevere. So we're not talking grind, we're talking grit. The ability to persevere, overcome, and move forward, not even in spite of, but because of the challenges, the failures, and the obstacles. So what are you doing? Like right now, inventory is an issue. Mm-hmm. I can't wait to hear what you're going to catch us up on, because we've been missing that the last couple of weeks.
Wow, the market really popped this last weekend. Yes. Really, and it's just all the conversations I've had with agents going into contract this last week and how competitive the market became just this last weekend. Yes. So the buyers are out.
The buyers are out. I love that. Mortgage purchase applications actually went down this last week because interest rates went up. Okay, but they were up the previous week,
even Easter weekend.
So yes, wow, crazy as that is.
That's interesting.
So we were actually really busy on Easter weekend.
Oh my gosh.
So it's this. How are you educating? How are you creating opportunities? How are you inspiring buyers to take advantage despite or even because of the obstacles and get in while others are afraid and sitting on the sidelines? How are you helping them engage? I love hearing that it popped. We'll talk a little bit about inventory, both locally and nationally. And then what can you do to continue to reach out? What conversations can you be having right now? Because what I don't want to do is have it then fizzle. Like we want to keep this going. Yes. Right?
Yes.
So where are we on the market? How you feeling?
Well, let's pop it up.
Yeah.
Let's get it going. Let's see if we can get this up. We've got a little bit of a different setup today, so I want to make sure I get this all done right. And so slideshow from beginning. There we go.
Perfect.
So let's make sure that's popping up right. Is that showing up right?
No, actually, the other one.
The other screen? Stop share. Hold on just a sec. Technical issues.
Oh, it's always the thing. And then, yeah.
This one. Cool. Looks like we got it up and running this time. So this covers the week of April 12th through April 18th. And it's kind of interesting, always the weekend after a holiday weekend. We didn't do our report last week, but Easter weekend took about a 15% decrease in the amount of showings and the amount of pending transactions that happened over Easter weekend. Even though it was down, I was still pleased with the title orders that came in over that week. They were still higher than what I was expecting. I expected it to be down a little bit more than that, but there were still buyers that were out there looking. And the buyers that were out there were probably the ones that are the deal hunters, the people that really have to move.
Agreed. So, we had a lot of first-time home buyers last week. On Easter weekend.
And so it's always a great idea to try and take advantage of that if you have buyers that are less competitive in this market, to try and get under contract over those holiday weekends. And coming up in May, let's talk about holiday weekends real quick.
Yes.
We got a lot going on in May. So Cinco de Mayo happens on a Friday.
Yes.
The following Sunday, May 12th is Mother's Day.
Yes.
And then we've got all of the high school and college graduations, and then it ends with Memorial Day weekend. So if you're trying to figure out when's the best time to list, I would tell you that if you're listing over a holiday weekend, or if you're in a school district where high school graduation is happening, you want to list earlier in the week to try and get some of those showings in ahead of the weekend time when people are hosting parties or getting together or gathering. And so listing maybe on a Monday or a Tuesday, if you're up against one of those holiday weekends, to try and get some of that early showing activity. I would definitely avoid Memorial Weekend. Memorial Weekend is really the kickoff to our summer. A lot of people are camping. I'll be at the pool all weekend with the kids because the pool opens up. And so a lot of people aren't out looking at homes over Memorial Weekend. And we end up seeing a dip in the market that's like 40 to 45% fewer units going under contract over that weekend specifically. Also not a great time to do price reductions over those holiday weekends. And so if you are going to do a price reduction, again, do it earlier in the week so you've got time for that to hit people's prospect matches. Hopefully they can get out and see the house before the weekend when they're going to be more active with other activities that are kind of distracting during the month of May. But we're in this really golden window of opportunity right now where it's after Easter weekend, it's before Cinco de Mayo, where the market really compresses down and we've seen a ton of activity in the marketplace, and the market really popped this last week. We'll go ahead and get into it.
I do love hearing that.
I was thrilled. And so looking at what happened over this last weekend, here's 2023. You can see how these cells started to light up red. These cells that ended up turning blue here, these were new listings coming on market and back on market activity. So there was actually a pop of back on market activity just this last weekend as people relisted their homes. About 40% of those 245 that came back on market were previously under contract. And so our fallout rate is still only about 10%, which is historically low. Historically, we see about a 15% fallout rate for units going under contract and then falling apart again. What I'm hearing most often is lending issues, where people are falling apart and then hitting the market back again.
Where they're actually, the borrowers are not able to close.
Yes.
Okay.
The borrowers are not, they either are terminating on loan conditions or they're not able to qualify for some reason.
Yeah. Not with us.
No, not with you guys. No, you guys do your good work up front.
Yes.
So you don't have to worry about that.
We've actually got a couple of saves in our pipeline right now.
Yes.
Yep.
It's always good to be the backup.
Yes.
Yes.
Agreed.
So looking at what happened this last week in terms of our market activity report, these are your market metrics where I track the inflow and the outflow of new business coming in each week. And so you can see that our average daily active count headed into last week and was about 3,800 homes available for sale. And that was down by about 0.2% from the previous week. We're still up 80% from where we were 1 year ago, but historically that's very low. Usually in the month of April, we have about 4,500 homes available for sale. So we're still historically short in terms of the active inventory that we have available for sale. But you can see that new listings really popped. We had about 1,300 new listings make their way to market, which increased from the past week by 39.8%.
So
which
this
was a huge pop of
yes.
activity that came in this last weekend. Again, back on markets ended up going up. We were sitting at about 22.5% up from where we were just the previous week and also 1 year ago. Expireds also went up, which was kind of interesting.
Yeah.
We usually don't see expireds pop up in the middle of the month. Usually it's the last day of the month based off of the way that you guys write your contracts. You set those to terminate at the end of the month. And so it was kind of interesting to see more units expire. We had 117 units expire, 99 withdrew, but pending transactions were up 20.3% over last weekend.
So when the basis of this report and the last weekend that you're comparing it to, is that Easter weekend?
That is Easter weekend.
Okay. So it puts this into perspective a little bit.
A little bit.
Yes.
We were down 10% over Easter weekend, but the weekend before that, we were up by about 2 or 3%. So it was probably more like a 10 to a 15% gain over where we were 2 weekends ago.
Got it.
Still a pop of market activity. Closed transactions were up by 15% this last weekend for people that wanted to close just before Easter weekend. But we're still down overall in terms of the amount of volume that we're closing. It was down by about 24.6% from the same week 1 year ago. Our predicted month supply of inventory over Easter weekend was 0.9 months worth of inventory. So it slightly softened over Easter weekend and became slightly less competitive, but it dropped right back down to 0.8 months worth of inventory, which is where we've been hanging out for about the last 6 weeks or so. And so that still means that multiple offers are plausible. It depends on where you are. We've got some real hot spots and some real cool spots. And again, it's those inner landlocked ring suburbs that run around the inside edge of C470. Think Highlands Ranch, think Littleton, Lakewood, Wheat Ridge, Arvada, Westminster. getting out into the eastern edge of Denver, the western edge of Aurora, those areas are really hot. So it's still cooler in central Denver than what we're seeing overall. There's still a trend away from more urban, densely populated neighborhoods into the suburbs right now, and specifically to the west of I-25, where we're seeing people move down I-70 a little bit further west. And so you'll see that in those areas that I just mentioned, that we're down to 0.3 to 0.5 months worth of inventory. So we're measuring inventory in days, where it's like 7 to 15 days worth of inventory in a lot of those markets, versus in central Denver, where it's sitting at 1.5 to 2 months worth of inventory. So they've got 1 or 2 homes to choose from within central Denver. In the outer ring suburbs, where we're getting out into Conifer, Evergreen, Pine, places like Parker, you're sitting closer to 2 months worth of inventory. So for every 1 buyer in the market, they have 2 homes to choose from. So it's going to be cooler in a lot of those areas. But overall, the market is still hot. This is really, you've got about a 3-week time period now where it's really the prime time before we start to get distracted with all of the May stuff. The odds of selling, which is where I take into account the available listings for sale versus those that go under contract and or close in the same week, and project it forward for a 4-week period of time for the next 30-day period, popped up to 66.8% odds of selling. And that came up week over week by about 3%, which is welcome. Now, usually in the month of April, we end up seeing this number hover around about 59%. So the odds of selling, even in light of having higher interest rates, and less inventory, the odds of selling is still 66.8%. The highest I'd ever measured that pre-COVID was 61%. So I'm thrilled with that number in terms of listing a home for sale right now. It's a really great time to be in the market as a seller. We're still looking at, based off of the units that went under contract just this last weekend, again, we had about 3,800 units. We had 3,800 units available for sale. And based off of what went under contract last weekend, in order to offset demand, we would need to have nearly 31,000 available listings for sale in our market to create that magical 6-month supply of inventory where we would have balance in our market.
And we have a tenth of that.
We have a tenth of that.
Right.
We're sitting at 12.5% of a balanced market right now.
Right.
So we don't have the inventory that we need to offset demand. Now, inventory has the tendency to climb as we get into April, May, June, July, August, and September. It's typically our highest month in terms of active listing inventory. Now, inventory is on the rise, but I am not expecting there to be a huge jump in the amount of active inventory as we get deeper into the summer months, because we have interest rate gridlock that's going on right now. Where it was, I've read a stat that it was 85% of homeowners are now locked in with an interest rate below 5%, and 60% are below 4% if they have a loan on their home at all.
99% of them below 6.
99% below
right
6.
Now we're hovering in the 6s.
Yes. And so a lot of people don't want to move into a smaller house for more money. So what they're doing is they're taking out HELOCs and renovating and staying where they are. It used to be that the average homeowner would stay in their home on average 5 to 7 years. Now we're looking at 10 years in their home. People are choosing to age in place and stay in the current home and renovate rather than move at this point. So I don't expect there to be a lot of inventory coming to market.
I was thinking about that even more, because we're talking about people renovating today because they don't want to move into a smaller house for more money. But think about what we did over the last 2.5 years, right? We were trapped in our homes. So what did we do? We renovated it. Like we got emotionally connected to the home that we were in. Now, some people will say they wanted to get away from that home as quickly as possible, right? Because they've been in it for so long. But for those that took the time to renovate it, to make it what they wanted, don't really want to leave it because now it's perfect.
Right.
And I have a really low monthly payment on it.
Right.
So that is just going to continue to hold on to the inventory. That in investors right now, you can't really get a fantastic cash flow investment right now. It's harder.
It's hard.
So they're holding on to them. They're just not selling them.
Right.
So those guys aren't selling. We're certainly not seeing existing home sales, and builders can't keep up.
Right.
We're not seeing the single family builds that we need.
Yes.
So this
builders
is
cannot keep up, and the places that builders are able to develop are far outside of the city.
Yes.
And so we're seeing a minimal infill right now where people are looking at closer towards inside the city, but we're seeing more of that outside of the city stuff that's coming in, and people don't necessarily want the commute. The transactions that I'm seeing right now are life-changing transactions where people have a life-changing circumstance where they have to move. And so it's birth, death, divorce, change of a job. And then you couple that with the fifth most stressful thing that you can deal with is moving. And so all of the transactions that I'm dealing with right now have these double challenges where we're coupling it with another life-changing circumstance where they're stressed out and they're hard transactions. It was a couple Wednesdays ago, I was dealing with 5 different probate transactions.
And I remember you were talking about that on the last market trends right before you left.
Yes.
Did those all close?
So we got them all taken care of. They're all done and closed, but they were just issues that were coming up because people were quit claiming properties. Yes. And so trying to go through and figure out the chain of title and what type of occupancy they had and what type of tenancy they had. And it just created this big convoluted mess. And so it takes a lot to go through some of those transactions. So if you have one of those, reach out to us and get an O&E ahead of time so that you know who's in title, how they hold title, and how we need to proceed with one of those transactions that are where we are dealing with the death.
That's fantastic advice, because we do a lot of investment classes, right? We always say, do not, because they make the quit claim form available. So anybody can fill it out. You can get it from Door's website. Yeah. And I'm like, don't do it. Don't do There's it. So much damage that can happen if you break that chain of title. So get an attorney, talk to the title company, and get an O&E. It makes total sense.
Yes, absolutely. Looking at showings this last week, look at that pop of showing activity. We ended up going up by 37.5% week over week in terms of the total number of showings that were set. There were 17,000 total showings that were set, which meant that you should have been getting about 4.4 shows per property per week. That was up from the 3.4 shows per property per week over Easter weekend. So a big pop of market activity. I expect this level of activity to continue for probably the next 3 to 4 weeks in terms of the number of showings per property. So again, when you're trying to gauge if you're priced right within the market or not, and you need to be faced with making a price reduction, your benchmark is 4.4 shows per property per week. So if you're not getting your 4.4 shows per property per week, you may need to consider a price reduction. Conversely, we're still looking at about 14 showings to go under contract. Buyers are still being more discerning about what they choose to put under contract right now. They're buying at the top of their debt to income ratios. They're paying a lot more money this year. They want turnkey homes. So you need to be staging. You need great photography. You need to be doing some of that updating in order to get people into these homes. But it's about 14 showings to go under contract. So if you've had a total of 14 showings and no offers, then it may be time to consider a price reduction. Median days on market dropped pretty drastically this last week. And so median days on market ended up going to, why is it not letting me go? There we go. Median days on market dropped from 7 median days over Easter weekend to 5 median days on market this last week. And that's, I mean, that's hovering close to where we were 1 year ago. And when I had conversations with my agents that went under contract this last weekend, they said it was insane. But it was 5 median days on market. So it's the buyers that are out there are looking at all the new stuff that's come on board. They've looked at everything that's out there. And if you're on the market for more than 5 median days, you may need to consider a price reduction at that point, because it's all that new stuff that's going under contract.
It feels a little bit like pandemic period in certain markets, right? What you were talking about
is interland offering sellers. Yep. Price reductions went down this last week by about 4.6%. So we only saw that 20% of what went under contract last week had made a price reduction, with 77% making no change to their price whatsoever. And the average price reduction actually went up this last week. Over Easter weekend, it was about a 4.3% price reduction. Now we're looking at about a 5.2% price reduction. We're about $40,000 off of that original asking price. And this is based off of all price points. So this is going to resonate best with those homes that are between $700,000 to $750,000 based off of our average prices in Metro Denver, which is why I take this and I break it out into $500,000 price points for you. And so if you're under $500,000, your market's going to look a little bit different, but this market,
your market is shrinking too.
It is shrinking. It is a very small portion of our market, about 22.6% of our overall market. But you can see based on the strategy sheet for 2023, it heated up and it turned to the darkest red that we've seen so far this year based on our strategy sheets for this last week. Our average daily active count fell by almost 2%. So we only had about 776 homes available for sale headed into last weekend. Coming soon's big pop of coming soon activity was up 62.1% for units headed into last weekend. Pending transactions increased by 10.2%. Back on markets were up by about 20%. New listings were up by 27.4%. And our month supply of inventory dropped to 0.4, which is the lowest on record so far this year. So again, signaling multiple multiple offers highly likely in this market. The odds of selling jumped up 1% to 77% odds of selling for this particular market, which is only about 10% lower than where we were 1 year ago after the pandemic. And that was still insane. But even though interest rates are what, 3 to 4% higher than where we were a year ago?
3%, yeah.
3% higher than where we were 1 year ago. Having a 77% odds of selling in this market is pretty insane to see that number. In this market, we would need to have about 11,000 available homes for sale, whereas we only have 776. So that means that we only have 7.1% of a balanced market in that under $500,000 segment. Showings popped by 35% week over week. And so we had 6,100 total showings that were set last week for homes that were under $500,000. That meant that you were getting about 8 shows per property per week. So if you didn't get 8 showings on your listing, that may be sign number 1 that you need to make a price reduction. Median days on market for Easter weekend was 5. And even last weekend, it was still 5. So we're still looking at very quick median days on market, with the bulk of homes going under contract in the first weekend if you're under that $500,000 mark.
And this price point, it makes total sense. It'll be interesting to see the other price points as well. But this price point, you would expect to have been busy during Easter because those buyers were out like crazy.
Yes. Definitely, because we're so short on inventory. We only have 70% of what we need. Looking at where we are for price reductions this last week, only 16.2% of the homes that were under $500,000 that went under contract last week made price reductions. The average price reduction was about 5.9%, or about $25,000 off of the original price. Homes 500 to $1 million. This is really the heat of our market, with about 60% of our overall inventory. Looking at our strategy sheet for this last week, we ended up seeing that the market really heated up in this market as well, where we're seeing a lot of those red cells poking in. Our average daily active count remained unchanged for this week. We've had no change whatsoever from Easter week to this last week. Coming soon's increased by 80.5%, going from Easter weekend into last weekend. And so we had about 157 units that were coming soon. New listings ended up increasing by nearly 50%, with 754 new listings making their way to market. Pending transactions were up 25.8% over last weekend, with 653 units going under contract, and our month supply of inventory still hung in there at 0.8. Over Easter weekend, it went up to 1 month worth of inventory. So you had a nice little weekend of opportunity if you were a buyer to be in the market, but it's gone away just in this last 1 week, where we've had a lot of new inventory. I mean, 754 new listings, 653 were pending.
That is fast.
Yes.
So
a lot of those units under contract.
And, that's interesting, because I was actually listening to a podcast yesterday morning, and that's a statistic that's happening across the country. The new listings are being soaked up right before they can ever become active listings.
Yes.
Right.
Yep, they sure are. The odds of selling increased nearly 4% week over week. It was up to 66.2% odds of selling. In this market, we would need to have about 17,000 available listings for sale, whereas we only have 13.1% of a balanced market. Showings in this market went up by 36.3% week over week. And that meant that you were getting about 4 shows per property per week. So if you didn't get your 4 showings, that could be sign number 1 that you need to make a price reduction. People were looking at on average 13.5, 14 homes before going under contract. So if you've had 13 to 14 showings and no offers, you may need to make a price reduction. Median days on market was 11 over Easter weekend. This last weekend, it dropped down to 6 median days on market for those units that went under contract. So again, it's all those new listings that are getting sucked up in the marketplace right now. Only 22.6% of the homes that went under contract last week made a price reduction. Average price reduction was about 4.6% off of the original price, or about $34,500 off of that original price. Once we go over $1 million, we're looking at a really small portion of our market. This only represents about 7.6% of our overall inventory in our marketplace. And looking at this last weekend, it warmed up a little bit, but it's not quite as warm as it was for that very first week in March, where we ended up seeing most of those red cells creep in. But it did warm up nicely, and the market has picked back up. Looking at where we are for units that were active, we ended up going up by about 1.3% in our average daily active count with 376 average daily active units. Coming soons were up 61% with 29 units that were ready to come to market. Pending transactions increased by 35.2% week over week. We ended up seeing our month supply of inventory from Easter weekend and the weekend before was sitting at 1.6 months worth of inventory. We're now down to 1.2 months worth of inventory. So this is still a very strong seller's market. The odds of selling increased by 1.4% over last weekend, being Easter weekend, to 54.3% odds of selling. We ended up seeing that in this market, we would need to have nearly 3,000 available units for sale to offset demand. So in this market, we're still very shy of inventory, where we only have 13.2% of a balanced market. Showings this week increased by 56.8% in the $1 to $1.5 million mark, with about 1,100 total showings that were set, which meant you should be getting about 3 shows per property per week. But they were looking at more homes before they went under contract. And so it was 16 showings to go under contract this last week. So if you've had a total of 16 showings and no offers, maybe time to consider a price reduction. However, those units that did go under contract last week, they went under contract in a median of 4.5 days. So that means that they were under contract probably before the weekend even started.
Yes.
They were under contract quickly. And so that resonates back with where we were back in 2022 for the pop of market activity that was in there. So again, it's all of those brand new listings that people want. They've seen everything else that's on the market, but they're hungry for that new inventory to continue to make its way to market. Of those units that did go under contract, it was only 25% made price reductions. And the average price reduction was a little bit larger this last week at 7.4%, or about $106,000 off of that original price. Last market that I can track on a weekly basis, $1.5 to $2 million, with 2.8% of the overall market. This market also picked up very nicely as we got into this last week in April, warmed up, but it's still not as high as it was during that first week in March for this particular market, but it is still very warm. Overall in this market, we have about 1.6 months worth of inventory. So it's still considered to be an extreme seller's market with less than 2 months worth of inventory. Average daily active count actually declined this last week by 1.5%, with only 193 total units available for sale. Pending transactions jumped 21.7% over this last week, and new listings were up 17.9%. Looking at where we are for the odds of selling, one slide too far, we're sitting at 48.2% versus where we were during that first week of March was 57.6% odds of selling. So it's still a very good odds of selling overall, but it's not as good as it was back at the beginning of March.
Interesting.
So it was really interesting to see that that market really popped early and those buyers were out early looking for this particular price segment. But we still have a 48.2% odds of selling, and that increased week over week by about 1.8%. Even in this market, we're short of supply. We would need to have about 1,500 total homes available for sale between $1.5 to $2 million. We only have 13.2% of a balanced market. Showings increased again week over week by about 28.1%, with 415 showings that were set in this market, with 2.2 shows per property per week. We're looking at about 14.8 shows to go under contract. So you've had a total of 14.8 showings and no offers. Maybe it's time to make a price reduction. In this market, it was 10 median days on market, which was actually up 1 day. Easter weekend, it was 9 median days on market.
That's interesting.
That is interesting.
Yes.
I don't know why that is. That usually doesn't happen. Usually in these higher end luxury markets, we end up seeing a bigger slowdown over these holiday weekends. But we went from 9 median days on market to 10 median days on market. Again, you can see here, we were really fast at the beginning of March and the beginning of April. And then it started to slow down just a little bit as we started to get more into April. We're sitting at about 18.5% of units that made price reductions last week. And the average price reduction was 7.9%, or about $163,000 off their original price. Looks like we've got some questions that have popped up, and so we'll go ahead and answer those real quick, and then we'll turn it over to Nicole for our greater update.
Yes.
Yeah, the economic update. Blah, blah, blah. Hi, Megan and Nicole. Thanks for the update. Megan, I am not seeing your weekly stat chart that you normally share via social media and email. I'd love to reshare that weekly chart. Is it still available? Yes, it will be available. So it didn't go out 2 weeks ago because I put my dog down right before the market update happened.
You did.
And then I was out of town last weekend. I sent it, but I didn't post it on social media. I was trying to stay off social media with the exception of a couple posts, just making sure everybody knew that I was out of town. And so, yes, that will be available as I get that out this week. And I will post that online as well as on in the email that I send out to you guys. Can you repeat the stat about 65% of homeowners under 4 or 5%?
Yes. So it's 85% are under 5%, 99% are under 6% interest rates. So we've got a large portion of homeowners. Remember, almost 40% don't even have a mortgage. So they have a zero.
That's crazy.
Yes.
That is crazy to me. I didn't hear how many months of inventory for 5 to 1 million. We're sitting at about 0.8 months worth of inventory in that market. Any way to break out 500 to a million, maybe 500 to 750, then 750 to a million. I have had to, I can't go back historically and recreate this data. I literally have to pull it every week in order to go through and do this. I can't go back and historically pull some of these status changes. I have to track it on a weekly basis. So I can't break it out any more than what I already have. I'm kind of locked into what I'm doing. What is the months of inventory for 500 to a million? Again, that's 0.8 months worth of inventory. If you need to list either April 28th or May 5th, which weekend would you list, given they're both holiday weekends? What's April 28th?
I was literally thinking that we had 2 weekends left before the holidays started. So somebody's going to have to jump in the chat and tell me what that weekend is, because my little holiday on the calendar doesn't tell me that. I'm looking right now.
April 28th is not Memorial Day. That's in May.
That's May. Yeah.
So I would go in April over going over May 5th for sure. The weekend before a holiday weekend, you tend to have more activity than the weekend after. And so
somebody's gonna have to jump online and tell us.
What was the odds of selling for 500 to 1,000? I missed it. It was about, it was 66% odds of selling, I believe, in that particular market. I will send that out to you later today so that you can take a look at that. Love your enthusiasm about the $1 to $1.5 million days on market from 9 to 10. Thanks for the details. Happy to give that to you. It's just interesting to see that that happened over, going into a holiday weekend where it was lower over a holiday weekend than it was the weekend following. Usually we end up seeing a bigger pop of activity the weekend following these holidays. And so it was just kind of interesting to see that happen.
So let's go ahead and get started and talk about what's happening, because we're seeing that although interest rates are definitely higher than we would like, they're 3% higher than they were during the pandemic, they are falling into a range. Right? We've actually been in a range since last November, which is why I think we're seeing these great pops, even though the interest rates just went up. So, and we'll talk a little bit about what they're doing, why they went up and how they went up. Let me see if I can't share my screen. Okay. There we go. So let's talk about it. So we got the, we're gonna make sure, yep, you got your Facebook up. Love it. Here we go. So the 10-year treasury yield has fallen into a range. And I went back to November to show kind of how long we've been here, because you forget, right? Because we really just feel the volatility after the massive explosion, right? I mean, our interest rates started climbing last April, and then it's just been volatile ever since then. But we've been really focused on the 6% interest rate, or 6 to 7 since November, with a little bit of a pop above 7 to 7.25. So the 10-year is staying there. And every time it starts to try to break out of this range, it sweeps back in again. It's going to need something really big, like the Fed is going to have to stop raising rates, or they might even have to start dropping, or we're going to see a big drop in inflation, which we're starting to see, which is exciting.
Good.
We are headed into a recession, whether you want to call it a soft recession, whether it's a no recession or hard landing, whatever it ends up being, the Fed is absolutely trying to engineer this soft landing. So let's talk a little bit about that. But we're seeing that we've been in this range, and every time we try to break out of it. So we're really smack in the middle of it right now. Our interest rates have been popping up a little bit lately. And in fact, it was a head scratcher, to be honest. We're like, why earlier this week did the rates go up? Yes, we had New York manufacturing come out a little bit higher. We had some news, and then we had some Fed members coming out saying that we needed to continue to raise the Fed rate. And that really kind of spooked the market. But every day it seems like there's something going on. This morning, even we saw the Dow was losing 200 points right off of the bat with the news on the initial jobless claims. So there's definitely just some simple spooking happening. But we're going to stay within this range until something bigger happens. Which is really a good thing for you guys, right? I mean, it's good in the sense that it creates stability. Stability creates an awareness and an opportunity where people start to get out of fear and into action. Nobody loves a 6.5% interest rate because we just had 3, right? But I like 6.5 better than I like 9 or 8 or 7. So can I go ahead and do it? Can I lock in a home while others are sitting on the sidelines? And then can I refinance down the road? That's what we have to continue to focus on.
Now, earlier in the year, there was a lot of talk and conversation about rates falling around May 10th.
Yes.
Can you talk a little bit about what that report signaled and if we're likely to see that happen?
And we still might. So I'm actually going to show some inflation graphs here in just a minute. And we're seeing that inflation is starting to come down. Now, May 10th is simply a comparison to last year. And because we had numbers that if we're starting to see any kind of drop, it will signal a bigger drop because of the numbers last year. It's all comparisons, right? We talk about this all the time. There's the facts and then there's comparisons, right? So it's this comparison of year over year where we could see those numbers dropping off. And a lot of it has to do with the owner's equivalent of rent, which is the housing numbers. And so the housing numbers hit their peak and they started to come down, but right there where they're hitting their peak, we're starting to see a year over year. So if we're lower now, we're going to start to see that it's going to feel even better, right? So it's a comparison. I mean, if you have low numbers last year and you have low numbers this year, it's flat. It doesn't, the year over year just kind of stays the same. So if we see that shift and change, which we're expecting to see on the May 10th CPI report. So we've got some big reports coming out at the beginning of May that would really give us a nice little drop in interest rates. We've got the unemployment numbers. We've got the Fed meeting is going to come out and the probabilities that they're going to raise the Fed rate a quarter. And then we have the CPI numbers. And if all of those work in our favor, we could actually see where we could drop into the high 5s instead of the mid 6s. Now, we don't know what the second half, I'm still hopeful, but people will say I'm too much of an optimist, right? But I'm still hopeful that we do see those lower interest rates the second half of the year that gives us an extended selling season. Because I know we could all use it, right? But we got to get some of those sellers out of their homes. They've got to start moving. And right now they're still just holding on to them, whether they're staying put or they're converting them into a rental. Either way, they're staying put.
Let's face it, guys, we can't peak in March and April.
No,
we can't.
Please no.
No.
Right.
No.
So our interest rates are kind of hovering around. So this last week, because our interest rates did spike, and if you saw that, the interest rates actually did climb. And again, not on really big news, just more on spooked markets and on the Fed members saying some things about continuing to raise the Fed rate. So we did see a little bit of a drop in that mortgage purchase application. But I wanted to go back to November on that one too, that yes, we've been seeing the ups and the downs. The week before last, Easter weekend, we saw a really nice lift in mortgage purchase applications. I know our team was super busy. I know.
So interesting.
And guys, so I want to double click on this really quickly because 2 years ago in 2021, we had a $4 trillion mortgage market, $4 trillion. This year, they're expecting $1.2 trillion.
Whoa.
It's going to be lower, right? We've chopped off 75% of the mortgage business. Now, you guys as real estate agents, you also have cash buyers, which is typically historically 20%. Maybe it's probably a little bit more than that right now.
About 20%.
Okay. So based on that, we're seeing that you're a little bit busier than we are. Of course, our refinances are really just more about debt consolidation and separations and divorces. So right now we're not seeing a lot of that, but that drop, I want to say that you want to work with a lender that's still working hard, right? Because a lot of lenders are seeing a big drop in their business because they were really focused on the refinances. And if they're not constantly seeing the things that's going to give you the success, which is why we're getting the fallout, which is what you were talking about in the beginning, that we're seeing some of those contracts fall apart at loan availability. And some of that very well could be because they rushed to get the home because there were multiple bids and now they don't want to pay $20,000, $50,000 over asking. And then some of it is because maybe the lender didn't do all the upfront work, or maybe the lender just hadn't seen that scenario in a while because their volume has dropped off and now they're only doing a couple loans a month. So definitely working with a team that's doing more volume is going to create a sense of stability and security on the fact that you're going to get to the closing table. That's really what we're trying to do for all of our clients. So mortgage purchase applications did drop a little bit. Sentiment increased just slightly. So the consumers are feeling a little bit better. 42% of them blamed high prices for eroding their personal finances. Yet I'm feeling okay. Like, I went through a lot of my savings. There's still a little bit of savings left. I'm starting to use my credit cards. I don't really want to adapt my lifestyle yet. I'm feeling like even if we go into a recession, it's not going to last that long. So the buyers that are out are getting aggressive, which we're seeing, right? So sentiment just inched up slightly. This is a good thing because consumer confidence is a big part of the economy. So now it's 3% below a year ago, but it's still 27% above where it was. And that rising sentiment, interestingly enough, is bigger for the lower incomes. So we're seeing more down payment assistance buyers come out. We're seeing FHA, the percentage of FHA applications is higher now. So we're seeing this, which kind of goes with your numbers because the jumbos had slowed down, but the lowest price points are on fire right now. So that lower income, they're feeling like, remember, there's 1.6 jobs for every unemployed person right now. Those lower income guys, I was talking to a friend yesterday and he was talking about the fact that he went to a restaurant and it was half empty because they couldn't seat the tables because there weren't enough workers, right? There's a lot of people that are finding better jobs and going and doing those jobs right now, especially that price point. Now, the higher income earners, remember, they're probably self-employed. They may own businesses. They may have more money investments. Investments haven't been doing very well. If you look at the stock market, it has come off of its highs. So that's why your higher income earners are feeling a little less excited about this market and this possible recession that we're in front of. But the lower income, they're ready. So being out there and educating. But overall, consumers like, I don't know. Like, I think I feel good. I'm not sure. My wallet is still okay. I'm spending a little bit on my credit cards. So they're just not really 100% sure. Right. But we are seeing the shifts in the economy underneath start to happen. So the small business optimism on the flip side just went down a little bit. They're not loving life because the retail sales actually went down 1%. Department stores are down 2.5%. Remember, just a couple months ago.
January was so weird.
Who goes to Macy's? So Macy's is feeling a little bit of the pain this month.
Yeah.
I was like, bye-bye, Macy's. Yeah. So retail sales is down. It's not a huge surprise that the small businesses are kind of trying to figure out, okay, my supply is catching up. The buyers are there, but they're just not there in full blast. They're getting pickier about what they're buying, which we are seeing also in real estate, why it's so critical to do your due diligence up front and prep that home because they're getting picky. Everything costs more.
Yes.
Right?
Yeah.
I don't want to spend all that money on something that I don't absolutely love. So we're definitely seeing that they're getting picky, and I understand why. So let's talk about some of those inflation numbers because there's a number of them that are all coming down, and I am loving this. It's slowing down the economy, which means we're heading into a recession. Because remember, recession is just two consecutive quarters of GDP decline, but it's also a myriad of other indicators that just talk about a slowing economy. Consumers stop spending as much. We've been spending everything like we were insatiable. So we're spending a little less. The prices are coming down a little bit. Now, these numbers are still positive year over year. So it's not like I'm getting a big discount. Things aren't on sale. They're just not costing as much more as they had been. They've been going up so rampantly, and now they're going up just less. So we want to get it to a point to where they're going up really at that 2%. 2% is the target. We're still above that right now. So the CPI came out and it did drop from 5% to 6%. Now, but the monthly numbers didn't. It did drop a little bit, but it actually didn't drop as much as expected, which is why the markets didn't react. We didn't really have a heyday. Our interest rates didn't go down with this report. I wish they did, but they didn't, even though we saw that big drop in the year over year numbers. But if we continue to see this, we will see interest rates will start getting better.
Good.
Absolutely.
Good.
So the month over month, the PPI report also came out, and this is a massive win. So it was just a year ago, it was at 11.7, a historic all-time record-breaking high. Now, the PPI is the producer price index. So this is all of those things that are the wholesaler costs. So all the costs to get that product to the retail shelves, right? So then you have the store seller who's going to up his price because he's paying his employees. So that's the CPI. But this is all the stuff to make the product, to get it to market. And it dropped as well from 4.7 to 2.7, which is really good news because this leads into the CPI. As this continues to stay lower, we're going to start to see that CPI, the consumer price index, keep falling. If this had turned upwards, then even though we had a down CPI month, we'd see the next month would have gone up. So this is a leading indicator for our CPI. Cash freight also came down. So this is the shipping component of PPI. So PPI is really the producers, the wholesalers. Cash freight is what does it take to get all those shippers, all the truckers going across the country? Gas went down, so the cash freight went down, which improves obviously the cost of everything. So to see this to continue to drop, it dropped another 1.5%. These are all leading indicators into the CPI. This is all phenomenal news for hopefully getting the Fed to raise our Fed rate one more time to another quarter, and then stop and then hold it there. And then of course the markets are all estimating and excited about and hopeful about that starting in September, we're actually going to see them start to drop the Fed rate. Although the Fed members will tell you no such thing is about to happen. So we'll see if they start doing that. That really means that we've got inflation under control and that we're starting to see the benefit of that, and our interest rates will follow and then they'll stay there. Up until they start to do something, we will see that inflation will have more of an impact on interest rates, but it could still have volatility. As the Fed rate starts to come down, that volatility will start to narrow as the difference between the 10-year Treasury yield and the 30-year fix starts to come back in line. Remember, those two are sisters. They are absolutely, they go up and down together, but right now they're at a 3% spread, which that has to do with the risk and volatility in our financial markets. And as the Fed drops the Fed rate, brings the short-term interest rates back in line, we'll see that risk will start to narrow. That's a good thing for all of us because all that means is it brings stability. Stability allows our consumers to make decisions, right? That's what we want. All of this leads into the knowledge behind the opportunity for stability. Initial jobless claims rose 5,000. It's not a massive change. Like if I expanded this to a 5-year, it's like a little blip, right? It's like, it's not a huge mover, but it was more than expected. And that happened this morning. And that's why our bonds are actually getting a little bit better. The stock market got a little worse going, uh-oh. Like it's happening, right? People are losing jobs and people are going on unemployment because this initial jobless claims means that people are going on unemployment. And this is what the Fed has been wanting. They want more unemployed people to reduce the number of jobs open per person so that they start to have less of that wage impact and wage spiral. Higher wages means that the store owners have to charge more for their product and all the things. And so it just keeps pushing up inflation. So this is a good thing, and it was a little bit bigger than what we expected, which is why the markets, I would say, a little overreacted this morning. So the layoffs are continuing, which is bringing this in. So interestingly enough, I've been seeing so far in April, Best Buy laid off. I went to Best Buy to go shopping for some things. Holy smack, there's nobody in there.
Nobody in there.
Nobody in there.
That's crazy.
It was annoying. It was like, just shut the store down.
Jeez.
So Best Buy is clearly dropping some folks. Redfin, Walmart, McDonald's, they were all headlines this month in April. You were just talking about that you were researching all the mortgage lenders that have been laying off.
That have been consolidated, that have been impacted by the real estate downturn over the last 9 months, that have gone out of business or have been acquired or have been laying off people. And the list was long.
It's really long. There's really a lot of lenders laying off, and a lot of them are trying not to even show. If they're not public, they're trying not to show. I've been hearing about some other lenders that had been doing some layoffs, and not making it public. But so yeah, we're definitely seeing lenders across the board, real estate offices across the board, especially real estate offices that have heavy W-2 employees, staff, right? And then Meta is laying off again. You'd really think that they just sweep through and rip the Band-Aid off all at the same time. They keep hitting the headlines with more layoffs. And that one actually just came out this morning that some folks had leaked out to the press that they were laying off a bunch of their IT folks. ESPN also is laying off. So are we heading into a recession? I would say yes, at some level.
Finally.
Yes.
We've been talking about this looming recession for a year.
Yes. Yes, but we are starting to see the slowdowns. We're not there yet. It could even come in the beginning of next year. So it's not like we're on the tip of it, but we're starting to see all of these economic indicators start to slow down, which we need and we want. But the demand continues to be there because you can't change birth rates 33 years ago. So I was actually looking at this, and this was just published again. And so the biggest three groups, 33-year-olds, 21-year-olds, and 51-year-olds, they're buyers. They're buyers. Our 33-year-olds, the average first-time home buyer is 34. The 21 Gen Z, I have three of those guys, and they all three own a home. And then the 51-year-old is really looking for that move-up home. We just have to help them get over the hump of leaving that home that has the lower interest rate, which is a conversation we're having on a daily basis. So let's talk about that demand, and specifically those millennials. They just got so much airplay. They got so much airplay. So Apartment List just came out with a report talking about the millennials, and they just tipped over 50% of them now own a home. So it happened. They took a little longer to get there. They waited. They had kids later. They got married later. They settled down later. The younger millennials and those Gen Zers behind them are ready to go do the things. They want the career. They want the house. They want the stability. But the older millennials were finding their path and they were enjoying life. So now 50% of them own homes. But there's a chunk of them that don't ever want to own a home. That's what's crushing me. We just have to help them see the opportunity. So increasingly millennials, almost 25% of them right now say they never really want to purchase. They just want to stay renting. So our job is to continue to educate on that opportunity. In fact, the biggest reason they're saying is affordability. Yes, some of them want flexibility. Some don't want to deal with home maintenance. I read that and I was like, lazy. Some of them
Nobody wants to deal with home maintenance.
Get over yourself.
Do it.
You just hire somebody. Even if you can't, it's like your best friend. Can you please come over and help me? That's what I do with my husband all the time. I hire him.
Nice.
Yeah.
Nice.
So, but a lot of them are saying that they can't afford it. So interestingly enough, the survey went further in to say, how much money do you have saved up for a down payment? And only 15% had more than $10,000 saved. 18% had less than $10,000, which is a little scary. And 67% said, I have no down payment money saved. So this is where I saw this, and instead of getting depressed about it, I thought, opportunity, right? Because that's what we do. So I'm like, okay, we need to start creating more education platforms, doing more videos, talking about setting up a strategy. If not now, when? What would it take to save? What would it look like to get down payment assistance? How little can you actually get into a home for? Now, I don't want anybody to be house poor, and you certainly don't want to run out all of your savings in order to get into a home. But there is a strategy for securing your financial stability and putting yourself into the long-term financial success of home ownership. This, to me, this chart, I love this chart because this chart screams opportunity, right? How do we get those others that haven't bought? And then they actually broke it out by metro. So here we are, we're right smack in the middle, and we're looking at under 50. We're sitting at about 47% of millennials own homes. Again, opportunity. 53% aren't doing it yet, and they need to know that they can. So we do a ton of videos. Every week we put out a Wednesday video talking about opportunities. And we have just on the last couple of weeks, we have 3 myths keeping you from financial freedom. And we talked about the fact that you don't have to have perfect credit. You don't have to have 20% down. You can get into a home, right? So these things that they're thinking that they can't, we just have to continue to educate. And then we have to continue to lay out the long-term financial success. You and I both totally believe in real estate as an investment.
Yes.
right? And so creating that, we just taught, I taught a 2-hour CE for DMAR earlier this week. And last week we had our Building Investment Empire. We'll be back in the office starting next week. So next month we'll be back in the office. But creating that strategy and that plan, that's my biggest thing, is how do I create a strategy? Because if not now, when? How do we get there to a point to where we've got that stability? Even one rental will get you there, right? I put together this chart and I was looking at, okay, if I could help my kids buy 5 rentals, where could they be in 30 years? And the kind of millions of dollars of net worth that they could have, and over $12,000 a month in rental income, using the most conservative 1% rental increases and 3.6% appreciation. I was like, why isn't everyone trying to stock up 1 or 2 homes? Just even 1 or 2, right? So opportunity, we just got to keep talking about it to make sure it's getting out there. So credit optimization should be a conversation that you're having with your buyers, because if they're feeling, they might be ashamed at what they think that their credit score is. You don't know, they're telling you no, like I can't do it, I can't afford it, now's not the right time, but it might be something to do with their credit and they don't want to talk about it. And that's fair. So we have a free credit optimization, having them talk to the lender and just open up that conversation. Why are you not wanting to jump into this? And maybe there's 10 reasons why logically they shouldn't be. But if it's something that they just simply don't want to talk about, and we really want to put together a strategy for improving their credit, then we want to get them there. So we have a free credit optimization. And then I have a partnership with other credit repair folks that can help them get over the hump. We also have down payment assistance programs like crazy. Not only us as a lending team, but the access to in the state of Colorado is abundance. So we have the ability to get either grants or silent seconds. We have the social equity program. We have so many opportunities to tap in to funds to help people to get over the hump, right? Making sure that they're within a budget range that makes sense and makes them feel safe, but getting over the hump of not having enough money saved. That massive slice of the pie of how many people have no money saved is we have to start talking into that. And remember, you can make up to $148,000 and still get into CHFA down payment assistance, and $176,000 with MMA. Now, if you're making $176,000, you should really have some money saved.
I would hope so.
I'm just saying that you should.
I would really hope so.
But if you don't, and there's a lot of reasons why in lifestyle you might not, so that can give you the opportunity to do that. And then of course, the social equity program, we love it. We do a lot of those. And then as a reminder, the 10% down ITIN, which is really a blessing, something that we didn't have before, but being able to get somebody into a home who doesn't have that social security number, doesn't have the full credentials yet, they're working off of the ITIN, we can do that with 10% down. So with that, let's see if we have any additional questions and kind of, well, we might even wrap up a couple minutes early.
That's all right. Recess. You guys get recess today.
Recess. All right. So what's the percentage of people moving into Colorado versus moving out of Colorado? I don't have that up top.
I haven't looked at those numbers lately. A great report to look at, Redfin.
Yeah, they do that
those numbers. And so I'd give Redfin look. Colorado, what is that? Migration report. So Colorado migration report, Redfin is what you would Google in order to get those numbers.
Yes, they have fantastic data.
Yep, they do. And it's current. It's like within a quarter versus looking at the census, which is like a year old.
The census is always dated and it doesn't. Now, another report, LinkedIn also has a lot of good information as well, because it'll show you where the job hunters are going. What is the average year of home appreciation? Oh, year over year home appreciation.
We're down. We're down from where we were 1 year ago. If we compare right now to where we were 1 year ago, we are down between 5 to 7% at this current moment. If we look at the same year over year numbers, now those aren't appreciation numbers, those are average sales price numbers that we're looking at. They're going to continue to report down for the next few months, but it is important to note, even though we're down year over year, home prices are climbing month over month at this point. So we've already gone through that phase of retraction. Now we're back into expansion mode, and it's going to take some time to make up the ground where we were, because we're not going to hit that $820,000 average sales price like we did last April. We're more likely to land in that $760,000, $775,000 range. So it's going to continue to report down for probably the next 4 or 5 months. Can someone get a DPA grant if they have funds?
They can. USDA will measure how much you have in assets and whether or not you can qualify for a USDA loan, but DPA, CHFA, and MMA do not.
Can you show us a more historic chart on interest rates to help our clients see where we are historic norms? The comparison to pandemic rates makes them look so high.
It does. Absolutely. We can get a longer, and I can even put that on social later today as far as how low interest rates are historically. But, you know, historically, we're looking at about 7 to 8% is kind of the average. So we're not that far under the average of historical rates. We've seen really high highs, and now we've seen really low lows.
Definitely. What credit score do you need for the I-10 loan? What's the interest rate range for those at the moment?
So definitely give us a call at the office. We can talk through what the different credit scores give you, the different down payment assistance requirements, or the down payment requirements. So I definitely would love to go with that, go through that with you over the phone, if I could put 2 words together.
Yep. Nisla wants to know, can I get info on the I-10 10% down?
Yes, if you can email or text me, and we'll send out our email blast. I know you send out an email blast, and then we also put this presentation on our Agent Ignite Facebook group page. So if you message me on social or if you text me, I can get you that.
I'm not 100% clear on the difference between sales price and appreciation, depreciation. I thought they were one and the same things. So it's a little bit different. When I track average sales prices, that's strictly the average sales price over time for a given month. Versus when you're looking at appreciation, they're actually doing matched pairs analysis for the same home that's sold over a period of time and then averaging out what their appreciation is. So when we look at the average sales price growth for all of 2022, we were actually up 11.7%, although appreciation, after we factored in the later part of the year where home prices fell, came in at 2 to 4%. And so appreciation is a much more complicated metric than it is for just tracking the average sales price.
And on appreciation, you're looking at those larger data aggregators where they're looking at individual homes, and every time they sell and they collect that data, whether it's through Fannie Mae or Freddie Mac or FHA, in order to get those numbers. It's really easy to get median and averages, and we can get them pretty quickly. The data aggregators are typically a month to 2 months behind.
Yep. And so is there a link to your weekly video on your website? There will be one that I will send out a copy of it. So if you've registered for this webinar, congratulations. You are now on my email list until one of us dies, and you will get a copy of this report every week. And a copy of the recording every week so that you guys get all of the current and up-to-date information, but I'll be sending that out in about an hour.
Sounds good.
Yeah, that takes us up to 10:59, 11 o'clock, almost right on the dot. And so we are all set. And so let us know if you guys have any further questions. You can always reach out to us by email. You'll have our email addresses and our contact information a little bit later today when we follow up with all of you. But in the future, we certainly hope that we'll get to see you at our closing tables. So please keep Nicole Rueth with One Trust Home Loans in mind for your upcoming mortgages. Movement mortgage. Movement mortgage. And me, Megan Aller with First American Title for your future transactions as you have those coming up. And we hope that we will, I'll send out the links for registration next week for all of the May updates. Can you believe it's May?
I cannot.
It's crazy.
And there's 5 weeks in May, aren't there?
Yes.
And a lot of holidays. Yes. So you've got two more weekends. I think of no holidays. I'm really gonna have to figure out what the last weekend
is. What April 28th is.
Did anybody come up with that?
What April 28th is? I don't know what that date. I don't know. Do I have the day off from work?
I really want the day off from work. I want it to be a holiday. I don't know that it is. But I think we get 2 more non-holiday weekends. So it's time to get busy, guys.
Awesome. So thanks so much. You guys have a good one. We'll see you guys next week.
Bye-bye.